We want to help them increase the value of their company. We want them to increase the multiple of their company, because ultimately we want them to live the life that they deserve in retirement, and we want them to leave a great legacy for their loved ones.
Yeah, and I think what's important about what your role you're playing is employees see what you're doing, because they're still going to be there.
Right.
Right. This is their second home. And I always say, it's finding the right buyer that's the right fit, that the overall value. I read an interesting statistic the other day that, almost 50% of businesses are sold or exited not voluntarily by the business owner, which I was a bit surprised about, because you think when you start a business, you're going to plan, you're going to exit it on your terms. And certainly there's situations where a business, there's a forced exit because of, some life tragedy, like, death or disability, the pandemic, divorce, a dispute with a partner. But I thought 50% was a significant number, that half the businesses are sold not by the wishes of the ownership. So today we're going to continue our conversation from our last podcast with Brian Kerrigan. Brian, welcome.
Thank you, Keith.
Brian's managing partner of Vision Growth, and he is an expert on helping owners plan for the exit of their company, and does it over an extended period of time, and has been doing it for a number of years. And so, Brian, that's an incredible stat, right? I mean,
it's amazing.
You never think about that when you think you're going to say a company, and then all of a sudden it's like, well, there's no buyer, or it's being sold at a discount because I didn't plan.
Right.
And so from your perspective, when I made that, how does that sit with you?
Well, it scares me to think that someone spent their lifetime building a business and they can lose, 50% of its value because they have an event in their life that they couldn't control. It's scary, but, one of the ways that we try to deal with that, each client that we work with has an emergency plan. That emergency plan takes effect as soon as there is a death, a disability, or some other reason why the business owner can't work. And it's a detailed plan about how someone else from the family or someone else from the outside can come in and continue to run the company in the same fashion that it's been run, and at the same time preserve the value of the asset for the family. Because if when you're starting to talk about early deaths or early disabilities, you really can't have that and a loss in your business value, because at some point you're not going to be able to work anymore, or your family's going to be without you, and they're going to need the full value of the company to be able to live their lives.
Yeah, it's interesting, like the emergency plan you're talking about, right? Because businesses that we talk to, they have emergency plans in there for the company, right? Like if we lose power, or there's an incident on the factory floor, or there's a breach, God forbid, from some kind of cybersecurity hack. Mm-hmm. They have all these plans they put into place, but having an emergency plan for a transitional ownership or transitional management, most owners don't even think about that.
No, and it's something that's one of the first things we cover with them when we actually come in, is we need to be able to put an emergency plan in place, because it's something that will preserve the value if something happens to the business owner. Because it's just, the consequences are dire if some event happens that disables or kills the business owner. And if that business is not set to move forward in that situation, you're going to lose the value, and you're going to lose the value very quickly.
Right. So, it's interesting because you have the emergency, and I look at involuntary as a couple different ways, right? Obviously, death, disability, divorce, disputes with a partner, but also, I'll give you an example. Involuntary could be that there's just no buyers,
right?
Because how can you have a buyer for my business, right? No one ever thinks about that, because you're in your silo, you're running your company. So again, I'll give you a quick example, and I'd love to hear from you as well. I get calls a lot from potential clients, referrals to us, and if it's not a fit for our auction process, how we work and how we help owners sell through, we try to help them some way else, right? Maybe introduce them to somebody that's handles smaller companies, or give them a couple ideas that they can move forward with. But I had a situation about a month ago, maybe more than that. And the owner called me up and he says, I want to sell. And he's second generation. And he's been taking out a really good chunk of change over the last 10 years. I said, well, but his sales have gone from 5 million to 2 million, right? I said, what happened with the sale? Well, we have one customer. I said, you have one customer? He said, we have one customer. My father got this customer years ago. And what we do is we just basically have, I'm talking 5 years ago. They've had this customer for a long time. Yeah. We have basically handled the legacy line of this product, which is in the medical field, right? So you got to keep it going for 7 years. But they're not giving us any new business, right? So he's still taking out the same amount of money, but sales have gone down. He's never had the inkling or energy or whatever to go out and diversify his customer base. And then I said, okay, so he's in manufacturing. Well, how about your management team? Well, it's really kind of me. And then I have my two key guys who do my, all my prep work and operation work and everything else. But they're both over 70. They want to retire. Yeah. And I'm like, there's not a buyer for that business, right?
No.
Right?
No, because there's really no value to the legacy line.
Right. So I said to him, I think the best thing, why don't you call one of your friendly competitors, in your region, and see if you can cut a deal with them. But so when you're like trying to get in early, like we talked about before, 3 to 5 to 7 years out, right? So when you walk into a situation, you see declining revenues, maybe margins are suppressed, maybe some customer concentration, and you have some time to work with the business. Right. How do you get them to buy in? Okay, we need to do the following. If you want to have an opportunity even to sell it.
Yeah. Well, I think that part of the process is going through and showing them that, the value of their business is declining on a daily basis. I mean, what you described is almost a lifestyle business. Exactly. It's not a saleable business.
It's not.
And they probably should have known 7 years before that it wasn't going to be a saleable business if they were dependent upon one customer and their two key people were over 70 years old and they wanted to retire. I mean, that's a case where you could have sort of turned over the management team, diversified the revenue streams, right. Put good sales processes in place, put good sales strategies in place, and you could have gone out and acquired more customers during that time period that would have diversified your revenue, but also would have gotten the sales up, back up to $5 million. Just decline. If I'm a buyer and I come in and look at a business and the sales have declined from $5 million to $2 million,
major red flag.
It's not attractive at all.
They're going to walk.
Yeah.
Unfortunately, it's just the nature of it. Unless they're, opportunistic buyer and they're going to pay a very, very small price, multiple for it. So, that's the kind of extreme situation I just want to talk about. But maybe you can go, look, you've been doing this a long time and you've had a lot of success. And I know all your clients greatly appreciate it. And they made the investment with you and, not just with you, but also additional investments in whether it be machinery and personnel and systems, et cetera, to get it there. I'd love to hear maybe a story where you started with a company doing 5-10 million, and we figured the value today was X, and then 5 years later we got them to 15-20 million, and the value was way up here Y, right? So yeah, just if you some of the things that you did to help them get there would be, I think, really helpful for our audience to understand. Yeah.
Well, I'll kind of give you an amalgamation because there's been so many different issues through every different companies throughout the years. But generally when we go in, we're gonna go in and we're very sales centric. So, I honestly believe that if you don't have sales, you don't have a company. And I think some people want to fight me on that and say operations is more important than sales. But at the end of the day, if you're driving sales and your margins are staying constant and you're growing your profit base, you're making, and your EBITDA checks out, you're going to have a much more valuable company. So I've gone into a lot of companies where, okay, let's say it's a $10 million business and they're making $2 million a year,
right,
but their margins have been deteriorating. And as the margins are deteriorating, they're becoming less attractive, and their multiples their profits are less, and their multiples becoming less appealing because they really don't seem to have a sustainable competitive advantage that will allow them to get a higher multiple. Mm-hmm. And when you walk into that situation, you need to do a couple different things. I mean, first you have to understand why the margins are going down. Are they not pricing their goods properly? Are they buying materials and not passing that cost on to customers? Are they inefficient, and do they have a lot of waste in their systems in terms of production if we're talking about a manufacturer? But the first thing we need to do is steady the margin.
Right.
And once we steady the margin, then we can focus on sales. Because there's not a lot of sense putting more sales into a system if they're not profitable.
They're not making money on it, right?
No.
It's interesting because we went through that scenario a couple different times, and over last year, that's become a real hot button issue because of supply chain problems, right. So, and especially in manufacturing, and you're probably with your current client list dealing with that every day, but it's like, okay, when and how much do I pass along to my customer? And we've had customers that tried to hold the margin, hold the price because they had a pretty good margin for 6 months and said, like, I got to pass it on now. So all of a sudden their margin was maybe 65% margins down at about 52. The first question the buyers said, well, why is your margin off? So, well, I was delaying passing along the price increases because, I'm afraid about losing the business, or it's been a long-term customer. I'm trying to work with them. It's our relationship. It's a business decision, right? But to your point is that's a constant hot button.
Yeah.
Because the devil's in the details. And when we, get into due diligence, to your point, the buyer, the transaction services group is going to want to see a margin, product SKU margin analysis, product line margin analysis, where the margin's been, how much is commodity driven because your margins are up, your prices are up because of commodities, but so your sales are up, but what's driving that? Is that really new business? Or is that because you raised your prices because of your costs went up? And you'd be surprised, if not shocked, of how many buyers will back away when the revenue's up, but it's not because of more sales, but because you raised your prices.
Right.
And even though you got even more margin. I mean, we had a situation about a year ago where our client purposely, like you said, cut out several lines of business. They went through the analysis you just talked about and said, we're not making real money on this. So they actually reduced the units that they were sold, but they raised their prices went up and their margin went up based on their higher profitable margins. And I couldn't believe it. The buyer walked away because they said, we were concerned about your unit sales. I'm like, it's like the airline industry.
Yeah.
I said, they consolidated to go. You try to get a seat on a plane right now. Everyone's full. Right? Because they took a lot of planes off out of service. And so you get on a plane right now, they're making much more money per seat versus having too many planes out there half full. So, you never know how a buyer's going to look at it. But to your point, that detailed analysis, make sure you're making money by product line, by SKU, whatever, right?
Absolutely.
And then you can focus on the growth piece.
Yeah, with declining margins, you always have to stabilize those margins before you really focus on sales, because as you know, as I think we talked about earlier, I mean, putting unprofitable sales into a company does you no good at the end of the day on a transaction.
So your first kind of like homework assignment when you do your scoring on this and you come in, you focus on the product, you focus on the margins. which I think is important. That's a key factor. And so when you go back and you sit with your client and say, hey, we got to reevaluate where you're at with this. What kind of pushback do you get? Because don't forget, they got to go to their customer and say, hey, by the way, I'm raising my prices by X.
First, I like to focus first internally, because the longer you're in like a manufacturing type business or a construction type business, the more waste creeps into your system. And, maybe the conversation before going back to the customer is say, okay, let's look at our systems and processes and see if we're operating as efficiently as possible. If we conclude that we're operating as efficiently as possible, well, then we're going to have to go back to the customer and have the conversation about raising the prices. But I first like to look internally at what the operations are doing and whether there's some accumulated waste and expense in the system.
Okay. So, it's interesting because it's almost like, larger companies have big departments, right? They have analysts and they're focused on this, and this, a million different things. And it's all reporting up to the CFO and say, hey, we got to look at this, we got to look at this. And so you kind of act as that more of a broader approach for, what typical client of yours, 20, 100 employees, 250 employees, Yeah,
I mean, it can range from 10 to 100 million, but I would say the sweet spot's in the 20 to 25, 100, 200 employees.
Right. So most of those employees, probably the smallest department is their financial department.
Right.
Right. Maybe a CFO, maybe a controller. If you're lucky, you have a cost accounting, and then you have your receivables, payables person, and you get your payroll, right? So it sounds like, what you're doing, you're adding that whole analyst type function on an ongoing basis to kind of monitor these things.
Right.
So that the owners will be in a good position. And even if some tragic event happens, you've been in there, you've helped them establish a plan so that if the sister or the cousin or the mother or the husband, whoever, can step into the operations, and even though they may not ever been there, at least there's a structure in place.
Yep.
That they don't have to call up customer A and say, hey, my husband passed away, I'm not running the business, or want to keep your work. That's not the answer the customer wants to hear. No. Right?
The customer's pretty nervous at that point.
Right. They want to hear, hey, unfortunately, Jim passed away, but then the sales guy, the sales engineer, the three of them get on a call together and say, look, we got it under control. Everything's running smoothly, and that our finances are in order, our bank's behind us, and that you can be assured that things will be delivered on a timely manner, right? Not just someone coming in off the street saying, I want to keep your business, who doesn't even know what it means to turn or grind or do an IOD on a part or whatever, or service, right? So maybe I'd love to hear, from a satisfaction perspective, because I'm always about, like, we just closed this deal the other day, and I called my client on the way up here, and I told him, I told him, look, I just want to let you know I really enjoyed working with you. I'm happy we got the outcome. I know it's been a long 9-month process, but I hope you feel good about it. Right. I mean, for me, that's what's amazing. And the answer is, thank you. I couldn't have done it without you. Your team was terrific, and I'm very happy. That's what I want to hear. Right.
That's what we all want to hear.
Right. So,
I mean, at the end of the day, that's what I'm looking for. I'm in a unique position because we actually kind of become part of the management team. We end up, especially in companies that are in that $20, $25 million range, you have a CFO who's really more accounting oriented and not strategy and analytically oriented. We become part of that management team, and we become close with these people, and we want to make sure that we're a positive step in the process for them. We want to help them increase the value of their company. We want them to increase the multiple of their company, because ultimately we want them to live the life that they deserve in retirement, and we want them to leave a great legacy for their loved ones.
Yeah, and I think what's important about what your role you're playing is employees see what you're doing, because they're still going to be there. Right. This is their second home. And I always say, it's finding the right buyer that's the right fit, that the overall value. And when we talk about value, it's not just the price. We've had a number of clients that have taken a lower price because they felt that the buyer was a better fit. And they did that because they felt that they are going to be the right person to drive the legacy of my company and treat my employees well, have a home to work, into the future, right? So what you're doing is when the employees see that you're in there doing what you're doing, right? Mm-hmm. They're seeing that the owner is looking to get his or her ducks in a row so that the business is sustainable, profitable, and that will continue on past, when they exit, which is going to be inevitable at some point in time.
Yeah. So,
well, Brian, this has been great. Any, one area we didn't really touch on is which, is I think is important also when you get involved is kind of like the estate and tax planning, right? Yeah. Make sure that they understand what their obligation is going to be to federal, state government, because we always bring that up. Yeah. To make sure they know that you don't want them to sit at the table and they're out to close and all of a sudden they got a $2 million tax bill.
No, the only thing I would say about that is start doing your tax planning well before the transaction.
Right.
Because it's going to do you no good to be 6 months out from a transaction trying to take valuation discounts on gifts into a trust.
Yeah, so we look at the financials, the sales, operations, the people, outside consultants, all kind of fall into this whole, exit planning for a company, and you're kind of quarterbacking it.
Yeah,
that's your job.
No, that's my job.
Make sure it all happens. As I was saying, any final thoughts before we wrap up? I really appreciate you coming today. It's been great.
The only final thought I would have is, sometimes it's not a sale, right? Sometimes it's just transfer to the next generation.
There you go. Yeah.
And we still serve a purpose there because we want to leave a stronger company to the next generation that will survive. As we pass generation to generation, they're more likely to not survive.
Great. Well, thank you, Brian Kerrigan, Vision Growth, Managing Partner. This has been terrific. We really appreciate you being here. Again, thank you for joining us today. My name is Keith D., President and Founder of Osage Advisors. Appreciate you joining our podcast today, The Ins and Outs of Selling a Business. To learn more about our company, Osage Advisors, please you can visit us on the website at osageadvisors.com. Feel free to send me an email at kdee@osageadvisors.com or give me a call at 860-767-3273, extension 1001. Again, thank you for being here today and have a great day.